In this quick video, we're going to focus on the differences between financial and managerial accounting. And if you've studied the subject of accounting at all, at any length, you know that there are two different methods of accounting, and each of those has a different purpose and provides information for different individuals. So to start us off, let's focus on financial accounting and really who it's meant to provide information for and how it provides information. Now, financial accounting is primarily built and developed for the needs of external stakeholders. And if you're familiar with the concept of a stakeholder is someone who has an interest in how the company operates and performs. And so these could be anyone from investors to government agencies like the SEC. Now, because of the fact that they're external, the key distinction here is that they do not work for the company. And so these are outsiders, but although they are outsiders, they still have an interest in how the company operates. Now, because these people are outside of the organization, they have different needs than someone who works inside the company. And because of that, there's different types of information that's provided. So as an external stakeholder, you're not necessarily interested in very specific reports on budgets for individual departments or payroll costs within a specific unit. You really want to look at things on a kind of a macro scale, kind of overall. And because of that, the information is going to be provided in the form of financial statements. And so those common financial statements can include a balance sheet, which is an account of the assets, liabilities, and equity within a company, can take the form of an income statement, which is one of the more important statements that reflects the profitability of a firm, can be a statement of cash flows, which is going to show the sources and of cash in terms of where that cash is coming from, but also where it's being spent. And it could also include a number of different statements, but these are the big three produced under financial accounting. Now, because again, that we're focusing on external stakeholders, there are certain provisions in place that dictate how those statements are kind of created, if you will. And the reason for that is we want there to be some consistency. So if you're looking at an income statement from one company, you want to have some assurances that it is created in a similar manner to a statement from a competitor so that you can do some kind of comparative analysis between the two. And so because of that, the financial accounting is governed by what we call generally accepted accounting principles, commonly referred to simply as GAAP or GAAP. And these are standards that are put in place for companies that produce documents for external stakeholders where they have to follow certain guidelines. And so these include providing relevant information, providing accurate information, and then providing information that's consistent over a period of time. So if a company utilizes one method of accounting for inventory, like last in, first out, or first in, first out, it continues to utilize that method of accounting for inventory and doesn't change every quarter, which, as you would know, makes it very difficult for an investor to make an accurate comparison between one quarter from the next. So that is a very important attribute of financial accounting, is this element of GAAP. Now, financial or managerial accounting, rather, is a little bit different, where financial accounting focuses on the needs of external stakeholders. Managerial accounting is going to focus on the needs of internal stakeholders. Now, stakeholders, being a consistent term between the two, is still someone who has an interest in how the company operates, in some ways, the performance of that company. But because they're internal, we're focusing on people within the organization. So this can include business managers that need to make decisions, company executives, and even employees who are making decisions. They too have a need for relevant accounting information. Now, with managerial accounting, it's much different than financial accounting. Because this is meant for internal stakeholders, they are not required to follow any exact reporting standards similar to generally accepted accounting principles. And that's because nobody outside of the organization is meant to see this information. It is built for the people that need to make decisions with that information. So this can include a number of different things in terms of the distinction between the two, but it can look at costs within a business unit. So if you're looking specifically at, let's say, production costs within a product line, can look at payroll costs. I mean, really the number of possible alternatives is almost limitless, and it really is at the discretion of the manager to request what kind of information that they need. Now, one key distinction here between these two is that financial accounting rather is primarily past looking, meaning it's reporting what has already taken place. And that is really a commonality because you've got these balance sheets and then income statements and statement of cash flows that are reporting what has already happened. With managerial accounting, we are looking to the future. We're trying to do projections to assess what could be the impact of a certain decision on a product line. If we decide to maybe maintain a piece of equipment versus replace it, what are the expected cash flows or what's the implication on productivity? So really it is very much so individualized. And again, it's not intended for people outside of the organization. Now, financial accounting plays a huge role in the planning process that takes place within businesses. And that's a really important element of financial accounting, or managerial accounting rather, is this planning aspect that business owners need access to this information to make profitable business decisions.